Good morning, everyone. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're all well. A few of the early birds up and at it. Luke, good to see you, mate. Alison in the house. I forgot to change the subject line today. So anyway, it says discount, but I'm not going to talk about discount. I'm going to talk about lending in a little bit. So hang around. It's not a repeat of the other day. Maybe we probably don't even remember what the headline was the other week. The data keeps flowing on through. Hey, good to see a few of you on already. Let us know if you knew. Sometimes we get some newbies here. We do this about 10 past 8 each morning. And my name's Jason Whitten. If you didn't already know, some of you do. Most of you do anyway. But if you're brand new, say hello in the chat. Say hello in the chat. Let us know where you are, what you're up to. Been doing this Wealth Coffee Chat for a few years now. Started around the COVID times, actually. And just kept on going, which is great. I enjoy our morning chats. Gives us a chance to get our skates on. Morning, Andrew. Good morning to you, mate. Facebook user, whoever's behind the veil, the private Facebook groups. Good morning. Great to see you. Thanks for joining. Like I said before, the headline was discount, one of the best strategies. But today, I'm not going to talk about discount. I forgot to change the headline on my my thing. Today, I'm going to talk about finance. What's going on, and what are the finance numbers showing us? As we go along. G'day, Jeff. How are you, mate? Yeah, those little strategies, Jeff, when it comes to a few properties settling at the same time, a little bit of jiggery pokery. Reach out to your coach and the property management team. They'll bring the strategies for you to get that done. It'll take a little bit to shake out. Always does when you settle, 10, 20, 30 properties at a time. But down there's still pretty healthy in the world of rental demand, that's for sure, Jeff. Morning, another Facebook user, whoever you are, wherever you are. Good morning to you. Right, let's talk about what the finance numbers are showing us. What's going on out in the world of finance and what indicators are we seeing? Now, the other day we talked about sort of early signs of market recovery. We talked about property prices, posting some gains, average or median property prices, posting some gains, across places, especially in Sydney at the moment. Some of those median prices are moving upwards. So what's going on? And let's talk about what we're seeing in the world of finance. Because for all of us, doesn't matter who you are, well, not all of us, most of us mere mortals, when it comes to the world of investing in real estate, investing in property, investing in property, we need finance, don't we? We need funding. We need funding, excuse me, to be able to purchase properties. And funding of late has been a bit challenging, right? Anyone notice that? So what's been going on? Unless you've been living under a rock, when I know most of you haven't, unless you've been living under a rock, folks, this is what's been going on for most Aussies, and we've got some New Zealanders in here as well. I'll see what's... oh, yeah, Apple Pencil's connected. Let's see if this works. Here we go. For most Aussies and New Zealanders, well, we've had, I think it's been now 12 interest rate rises or cash rate rises, folks, in a row. Now, what does that do to people's confidence? Well, it maybe puts a little bit of a pause, a bit of an uncertainty in the general step, the general hop, skip, and a jump of property investors and property owners. Now, what have we seen? What happened the other day? Well, we've had a pause. We've had a pause in the cash rate, and it is commonly believed that we are getting close to the top of our cash rate interest cycle. And tell me, team in the chat, why do most economists and financially people, and economists is usually, wildly inaccurate when you hear, hey, what happened to all those, 30% house price drops, economists? But anyway, so tell me, what has given pause to the RBA to back off on increasing the cash rate? Put that in the chat. And the answer's on the screen anyway, so probably giving the answer away. So what's given pause to the RBA to pause the cash rate increasing is the direction of our inflation. Now, their job is to try and keep inflation in this sort of band here. Both New Zealand and Australia are out of whack when it comes to that number and that measurement. What do? They put up the cash rate, and away they go, right? So that's where we've been. Where are we now? What are we seeing right now in the world of lending? Well, let's have a look at what's going on, right? If we have a bit of a sticky beak at, these sections here, and we go kind of this section to kind of there, then that section to kind of there, what's happened? So let's break this down on what we've seen. Yeah, exactly, Jeff. Let's break this down and have a look at what we've seen in recent history. This one here, a small, more significant reduction for investors than others, but owner occupiers kind of travelled along at a okay rate, but we did have an issue here. What was that section? What was section number 1, team? Section number 2 and section number 3. Tell me, what were those sections as we were traveling along in the world of property investing? And this is, difference when COVID's a different kettle of fish as well. But what were those sections? What was section number 1? Section number 1 was mostly, when it came to lending, the issue of APRA. The Australian Prudential Regulatory Authority came in and made some moves that really caused investment lending to significantly reduce. And if you look at this sort of, let's say 8 or 10%, it came down to 5%. That was a sort of, a 40% reduction in investor lending, right? And so we get to, the end of this section where COVID really came into play. COVID came into play. Section number 2 is interest rates went to the lowest in history. All right, when you have cheap money and it doesn't cost a lot, and the government is giving the money away like drunken sailors to every first home buyer ever, then and you'll see in the data in the next one, it boomed, right? So lending went crazy, and this was sort of the 2% interest and the cash rate was like 0.05 or something like that. And then what happened here? This is 12 interest rate rises or cash rate rises in a row. Cash rate. So the amount of loans obviously tracking along the costings, but here's the point. Here's the little bit that we want to talk about. These green shoots here. What's the go here? What's going on? Well, the comfort factor, the understanding, the demand for buying a property, lending money, those things is now settled into kind of, hey, we've got what's called a new normal. A new normal. Okay. There's a new normal around, folks. You know what? The new normal is, 5.5%, 6.5% interest rates, maybe a bit more. Like, let's call it 6 to 7% interest rates. That's what the new normal is. So it takes about 6 to 12 months for people to get used to the new normal, and that's what the new norm is. We move on. We move on. The media get over talking about interest rates every 5 minutes, and they find something else to talk about. Okay, so the green shoots, the first early signs of what's going on when it comes to the volumes of loans and the uptick again from investors and first home buyers. Okay. One of the reasons investors are back in the market, tell me, folks, what's helped many investors get back in the market? At the same time, these lending volumes were going down and interest rates were going up. What was going up at lightning speed, team? Lightning speed. Now, the capital growth had occurred. Put it in the chat. What was happening as interest rates were going up? Something was going up at the same time, trying to keep pace with the cost, the biggest cost of our of ownership when it comes to being an investor. But what was going up as well? Wages were going up, Chris. You're dead right. Wages went up, values went up, and what else went up? The rents went up as well. So we had wages increase, we had values go up, and we had rents go up. So by and large, the rest of the mechanism we're talking about when it comes to lending and borrowing was trying to, balance itself out. Sam calls it the mean reversion, right? When something goes down below what its long-term normal is, it always reverts to kind of the average mean over time. Okay, so we had lending a bit more difficult, the cost being passed on, and some values being realigned and reestablished for us as property investors. So what is it telling us right now? Again, what's telling us we're after, 12 straight interest rate rises, investors and owner occupiers and in general are settling into the new normal. Okay. Now, it doesn't mean they're enjoying it. They might be lamenting, from 1-2% interest costs, but it's the new normal. So, and we're seeing that, team. We're seeing that play out. We're seeing that play out in the market. We're seeing that play out in the market when it comes to, these factors. So, and last but not least, the investors are back in the house. All right, the investors. Oh. My chart's jiggery pokered. But the investors are back in the share of lending. Okay. they are now able to, or starting to, again, get a little bit more mojo on because the rents and the ability to borrow is flattening out, is normaling out. And so a few things are occurring which we all are going to benefit from. And I think, Alison, you were talking about one a moment ago, all right, which is the lenders. Well, now, tell me, and you can chuck it in the chat if you want, do the banks like making less money than they did last year, or do they want to make more money? Simple question. The lenders, the banks, some of the largest successful businesses in Australia, are they going to look into the next year or two and go, oh yeah, it's fine, completely fine. We're happy to write less loans and we're happy to lose money. What do you reckon? Now, they've all done their interest rate rises and they're repricing their loans and all that sort of stuff, and they've done most of that. They're probably a little bit more of that for the rest of the year. But they're looking into the next financial year or so. And what are they seeing, folks? What are they seeing? What do the banks need to do? Tell me. If they don't make this, then their share price goes down. Put in the chat. What do they need to make? They need to make we all know what the banks need to make, don't we? They need to make a profit. They need to make a profit. They're not going to go, oh, profits are down. Please don't sell your bank shares. Please don't sell your bank shares. We promise we'll get some more profits later. Okay, that's not going to happen. So my cryptic conversation, my point is, what are the banks doing about it right now? Does anybody know? And Alison, you probably know this. What are the banks doing? And they're breaking rank right now. They're breaking rank right now. Yep, heads roll. They don't make a profit. Exactly, Luke. The banks are making a breaking rank right now, and they're doing some things that that are causing a bit of a stir. Tell me, what do you think they're doing? And I'm going to show you something in a second. Few of you know this. Put it in the chat for me. Yep, they're reducing buffers. Now, did APRA come out and say, oh, listen, it's time to reduce your buffers? We talked about this the other day. Did APRA come out and say, oh, okay, everyone, it's fine. You can reduce your buffers. Now, this is a little bit of software that we use at Positive, and it's excellent when it comes to the world of borrowing, right? So old Tommy Test here, got him in, and I've just put it in very simply. Tommy's, 150, he's trying to borrow some money, right? And if you look up the top here, what did I put down here? He's trying to borrow 600,000. He wants a loan of 600. He's probably going to try and buy a property of, let's say, 700 or something like that, right? So let's have a look at this. Latrobe says, all right, Tommy can have 650, and the rest of them. Isn't it interesting? I always love this stuff. Why does ING say Tommy can have 400 and Latrobe says he can have 651, right? You're like, okay, how does all that work? Well, it all works in policies. And we've said this before, not all lenders are created equal. But you can have a look at this, right? You can have a look at monthly surplus, debt to income ratios. So they calculate a certain thing. And then they've got an assessment rate here, product rate, assessment rate. All right. So if he borrows down here from ING, 6%. If he borrows from Latrobe, 7.3. So they're pricing risk. Okay, that's fine. I'm actually happy with that. I think depending on how they analyze the risk, to be honest, but fine. Let's have a look at the assessment rate. All right. Assessment rate 9. It's all 3%. It's all 3% or thereabout, and maybe even a smidgen more. Right. Okay. Let's have a look at this then. Okay. Well, in our little calculator, this is quite interesting. Oh, hang on. Additional information. Let's click on this. Let's click on what's going on in this world. Now, this applies. Streamlined refinance, Westpac, CBA, Pepper, Bank West, Ubank, maybe it's sort of in maintenance. So, okay. Well, these ones, Westpac, CBA, Pepper, and Bank West, look like they're all breaking rank. What does it mean? Let's click on this here. Apply special refinance assessment rate. All right. Okay. So let's see what it does. Let's see. Oh, check it out, folks. Check it out. at the top. CBA now, CBA comes in as a winner chicken dinner. They're going to give. Now, this is applying to refinances at the moment, right? So they're all looking for the refinance money, right? However, this is an interesting one, isn't it? Right? They drop the assessment rate, they drop the product rate, and the max capacity is up. Okay, so interesting times in the world of borrowing, ladies and gents. Interesting times in the world of borrowing. So, what does it all mean? What's the takeaway this morning? Lending is becoming a little bit more flexible. The majority of the market believes we've found we're close to the top. The risk is getting less, so they're happy to borrow or lend a bit more, depending on the types of properties they're lending to. There you go. I think that's what is that telling us? Well, it's telling us that for you and me, maybe the harder times are over. We've found a new normal, and maybe it's going to be easier, slightly easier, depending on your position and situation, to borrow in the next little bit. I think that's the takeaway for me. What do you think the takeaway is? Chuck it in the chat. What's your takeaway on this one, team? Because I reckon we've gone through most of the challenges. There might be one, maybe two at a push, more cash rate increases. I think that would be just leftover issues, inflation down, a lot of uncertainty economically, like Jeff said, cancelling of the Olympics, all sorts of things. I think the governments are getting it. The governments are saying, all right, well, let's not put fuel on this fire. Anyway, there you go. So that's it, team. That's it from me. Join me again tomorrow if you want. We'll come and hang out and do the same thing. Well, we won't do the same thing. We'll do something different, but we'll have a chat. Anyway, a wealth coffee chat, that is. And let me know in the chat if there's anything that you want me to cover. But that's it from me, folks. Over and out. Remember, for those who have been here a few times, we've got a saying: if you're brand new, you need to know it. This thing's a marathon, not a sprint. It's going to take time to build your property portfolio. Don't give up, because it does take a bit of effort. And buy good property and keep the damn thing. Buy well, don't sell. That's what we say. All right, folks. That's it from me. Yeah, Fenton. He's been a bit MIA, Jeff. He's been crook. He had a baby, and now he's gone to Poland for 4 weeks on holiday with his wife. That's where his wife's from. Anyway, Fenton, we'll have to get the whip on him when he gets back. Jeff, have to get the whip on him. All right, folks, that's it. I'm rubbing on now. You guys be good, be well. Wealth Coffee Chat over and out. Till next time, you guys take care. Bye for now.